office. Well, let's move on and get back to markets now. We have emerging markets commentator Geoffrey Dennis with us this morning. Mr. Dennis, thanks so much. Always a pleasure having you on the show. So, from our perspective here, while we watch all these parlays that the US is having with other countries, we just want to understand when this deal gets done, because both sides have been talking in a reconciliatory tone, but we are yet to see any specifics. What's your sense on how this is progressing and whether investors can actually look forward to that deal getting done?
With respect to India, I assume you mean, right?
Yes, India and the US, the trade agreement, and knocking off that 50% tariff.
It's difficult for India or getting a deal between the US and India because, of course, of these agricultural sectors that India does not want to open up fully to US exports. And I think that's probably the biggest hurdle that we've got. But ultimately, I think, as with so many other countries, I think a deal will be done. It just, I think it's going to be slightly more complicated than some others, because obviously agriculture is massively important to the Indian economy by definition. And there are certain sectors that are not exactly closed to foreigners, but there are tariffs on those. And I think the Indian government is rather reluctant to open up those sectors to free competition. And so I think that's the big stumbling block. But I would be surprised if we don't get a deal in the next month or two.
Yeah, no, absolutely. And we'd be surprised too, Geoffrey, if that something doesn't come through. And of course, I mean, the actual rates also will matter, right? I mean, markets are saying, well, anything between 16 and 18% effective perhaps works, but anything over 20 is going to be not great news, because, I mean, that puts India at a disadvantage relative to others. So, yeah, I mean, we'll see what happens. The big question of our times, Geoffrey, of course, is what's happening in the US, right? NASDAQ is down 7% from its recent highs. And the question is really whether this is a technical shake-off or this is a real rethink in terms of, investor confidence and owning the AI trade. What do you think?
I think it's a partial move down. I don't think it's a massive correction. I certainly don't think it's a February, March 2000 situation. The companies that are under pressure now are in much, much better shape than the companies were at the peak of the dot-com collapse, or the dot-com bubble, I should say. And there are a number of supports here still for markets. I mean, earnings growth has been good. Bond yields are staying pretty stable. The dollar's been pretty stable. And I think that although there are concerns, obviously, about the amount of investment these companies are doing, particularly in data centers, et cetera, and there's all this concern about individual companies investing in other companies who then invest in other companies, et cetera, making this sort of circular investment process, which bothers people a little bit. But at the end of the day, I don't see this as being a major pullback. I think we're probably short-term somewhere near the bottom, probably quite healthy. And I think markets will stabilize in the next few days. We'll probably have a good run up to the end of the year.
All right, Geoffrey, good to see you. And as always, and you have maintained that on the longer-term basis, India is the market to go to. But those FI flows, they are missing. A lot of investors like the India story, but they're not showing us the money. The holding of FIs here in the Indian markets is at multi-year lows. Do you think it's time that we gradually see some of that FI money coming back? Because some of these AI-related trades, they're getting a little bit expensive, little over-owned as well. India fundamentally should start looking better as earnings come back. Do you think we should be prepared for the FIs to come back?
I think so. I mean, this is a conversation we've obviously had before, and it's something I've been thinking for quite some time. Now, I think one of the interesting things about what's going on here recently is China's pulled back certainly more than India has done. There are continuing doubts, of course, about the Chinese economy in large chunks of the Chinese economy, in particular, the lack of consumer spending growth in relative terms in the property sector. You've now got this spat between China and Japan as well. So I think some of the heat is coming out a little bit of the Chinese market. That's going to pull money back towards India ultimately. And as you've said already at the start of the program here, In this pullback we've seen in global markets, driven above all by the US, India's been a relative outperformer. Now, you don't get these flows suddenly turning around in over just 3 or 4 days. You probably need to see a period of outperformance here to really drag some of these foreigners back in. But I think this would be exactly the wrong time to get too negative at India. I think there's so much good going on in India. The economy looks in decent shape. The inflation numbers, albeit I'm sure for temporary reasons, partly the food price story, is in tremendous shape, and that possibly gives the RBI the chance to reduce interest rates, etc. You've got some simplification on the tax side. So I do think it's a matter of time potentially, but I wonder what's going to help here is if the China bubble itself starts to blow itself out to a certain extent, and that will, I think, encourage investors back to India. On a 3 to 6 month view, I would much prefer to be in India at this point now than in China.
Great.
All right, Geoffrey, we'll leave it there. Thank you very much for joining us. Good speaking with you, and appreciate your time here on CNBC-TV18. Well.